Hi, do you get nervous when a stock goes on a downward trend? Most people's reactions are a combination of the two. One is to sell off immediately. The other is to buy more to spread out the cost. Today, I'll use Netflix as an example to show how to make a profit in a bearish market. Today, we'll share 4 option trading strategies you can use when feeling bearish. 1. How to buy a put. 2. How to buy a put calendar spread. 3. How to sell a call. 4. How to sell a call spread. At the end of the video, I'll let you know which strategy is my favorite. So, how do you buy a put to anticipate a downward trend? Looking at the price chart of Netflix, we can see a clear downward trend since the company disclosed their Q1 earnings. The stock has dropped 10% in 2 weeks. If you reference Morningstar's fair value of Netflix, the stock is only worth $250. So we expect Netflix price to continue to drop. Looking at the previous low of 497, we can buy a put option at 495 to anticipate the bearish movement. It costs around $1,185 to buy a $495 put that expires next month. If the stock price drops below 495 before expiration, we can exercise the option to sell 100 shares at $495, and we make 100 for every $1 decrease. But the probability of profit is only 30%, so it's not a high probability trade. If Netflix goes on a long downward trend, the maximum theoretical profit of the trade is $48,000 as the price heads towards zero. This is unlikely to happen. But from a different perspective, if you already own Netflix stocks, buying put options is a good way to minimize your losses. You have the right to sell 100 stocks at $495 no matter how far the price falls. Even though the maximum profit of a long put is 100 times the strike price, but a long put is so expensive. Not to mention the fact that if you guess it wrong, the value of the option goes to zero. So we can consider a higher leverage strategy of buying a put calendar spread to profit from a market downturn. It is more difficult to profit from a calendar spread than from a long put because you need to be very accurate in guessing both direction and the size of the downturn to be profitable. But the advantage of a calendar spread is a lower cost of trade and a high leverage. If we look at the Netflix price chart from last year, the downward fluctuation is usually between $50 to $100. So we can buy a put calendar spread that is $100 below the current market price. A bearish calendar spread is made up of a short put that expires next month and a long put that expires in 2 months or more. The maximum profit occurs when the stock price falls to exactly the strike price within a month. When trading in TD Ameritrade, we can find the puts that expire next month and right-click to buy calendar. After changing the quantity to 1, we change the buy put to expire the month after. Now we can analyze the trade. We can see the cost of this calendar spread is around $90. If the stock price drops to the strike price within a month, we can make $1,500, a 15x return on capital. But it is very difficult to pull off this trade, and you will lose the initial investment if you are wrong about the trade. Since we have covered the strategies on buying options, now we can talk about how to be the seller of options. How do you sell a call option for a bearish outlook? If we believe the stock price will continue to fall, we can sell a call option very close to the market price at around 40 delta. As an option seller, we can receive the $1,205 premium up front. Because Netflix is an expensive and volatile stock, the naked call we sell would need a buying power of over $8,600, resulting in a return on capital of around 14%. The analysis of this trade shows there is a 68% chance of profit after 1 month. As long as the stock price remains below our strike price, we can collect the full premium. The drawback of this trade is if we are wrong about a direction of the stock price, we, as the seller, will lose $100 for every $1 price increase, with a theoretical maximum loss of infinity. So, how do we sell options in a safe way? We can sell a call spread. We can buy a call at a higher strike price to cap the loss of our short call. This way, the buying power required will be reduced as well. Even though the call spread has lower premium than the naked call, only $175, while maintaining the same 68% chance of profit, but a lower buying power of $325 means we can have a return on capital of more than 54%. We discussed 4 bearish option strategies today, and my personal favorite is selling the call spread. It has the highest probability of profit and a great return on capital. As a seller, we can simply wait for the option to decay in value, then exit before the market price crosses the strike price. If you enjoyed my analysis on trading options in the US market, please like and share my video and subscribe to my channel. Thank you.